Hello everybody and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer. Today we are going to be analyzing Nike stock. As always, this is not individual investing advice. This is just how I analyze stocks. So I've been repeatedly asked in the comment section of videos, and I've had Nike up on the chalkboard for a while, so I feel a little bad about not getting to it. So I'm going to do Nike today, or Nike, depending on how you want to say it. Ticker NKE. I assume most people are familiar with Nike and what they do. Sporting equipment, shoes, that type of thing. All right, so where to start here? Let's start with, I've covered the stock in the past, which is why I was kind of slow to do it. And I actually thought I had covered it more recently. When I looked, the last time I covered it was actually October of 2023, right after I relaunched the channel. So back in so for those that are new, I've been doing this about 10 years. Most of that time over on Seeking Alpha. I should say this is my 10th year. So I started toward the end of 2015. So I haven't quite hit 10 years yet. But I'm in my 10th year of writing stock analysis. But I wasn't on YouTube for a long time. And in early 2021, for the first quarter, I sort of experimented just to kind of get a feel for it, see if YouTube was something that I wanted to do. And I did it for about a quarter in the first quarter of 2021. And then I had a couple videos kind of sporadically after that on the channel. But for the most part, I didn't really use YouTube for public things. I just used it for like video tutorials and things like that in the Cyclical Investors Club service. So that's kind of the setup. But Nike was one of the stocks that I covered back in 2021. It was one of the first videos I ever made on here. On January 3rd, 2021, I had Nike as a sell. And then I had it as another sell when I relaunched the channel. It's like a trend. Back on October 17th, 2023. I'm looking at my notes here. So let's take a quick look. So before we get into that history, we can take a quick look here at the long-term history, which is pretty good. Obviously, I mean, Nike wouldn't grow to be as big as it is if it hadn't grown their business over a long period of time. So this goes back to 2004. This dark green shaded area on the fast graph is, let's get rid of some of this stuff. I usually try to just keep the dividend trend and the earnings up here in the price. So the dark green shaded area with the orange line here is earnings per share. And up and through, we'll call it 2017, like mid 2017, they grew earnings really well, and they had been doing that for, decades, basically. So it had been a great stock up until that point. And then earnings essentially kind of flatten out here. So let's see how I want to do this. On the fast graph, you have lots of ways you can look at things. How about we look at it like this for now? Which is nice. And I do have a 25% off affiliate link for Fast Graphs down in the description. They do have free trials. So if it looks like it's useful to you, use that link. You get a discount. You get to try it for free. I contacted them because I always use Fast Graphs and asked them if they had an affiliate program, and they did. So they didn't reach out to me or anything. I've been using this almost as long as I've been writing about investing. So I find it really useful, especially in the initial, like the first 70% of investing. Fast Graphs is really useful. And then usually the last kind of 30%, I have very specific things that might not be on the basic version, which is what I'm using here. Okay, so what we see here, let's actually go here. We'll forget about this year, right? Let's look at last year. Really what we see are kind of flattish earnings growth if you include inflation. Now, EPS growth during this time period was 8.79%, okay? That's going to measure from this point in mid 2015 to this point in mid last year, all right? Which is when their fiscal years end. So we have, how many years is that? 1, 2, 3, 4, 5, 6, 7, 8, 9. So almost 10 years. And if we look forward from here, it will be 10 years. If you just measure point to point and you assume a smooth transition here on earnings per share, you get 8.79%, which is pretty good. But that doesn't include this decline in earnings here, which if you were just collecting these earnings, which is how I like to think about it, you actually wouldn't have collected a smooth earnings amount, right? This would have been less. So if you take that into consideration, which is what I do, then that lowers the real earnings growth. The earnings growth rate I use is really like an earnings growth CAGR. It's like an accumulated earnings CAGR. I'm not sure. There's probably I should look up the real word. Maybe I'll ask AI and try to describe what it is that I'm doing. And then I would sound smarter in these videos. But what I care about is how much money I can collect in earnings over time, and then what kind of CAGR that works out to for the earnings growth, right? So I include these downturns in my calculation when I do it. So my earnings growth rates, unless it's a company that grows earnings every single year, is almost always lower than the fast graph if they're making new highs. Now, if we move the fast graph forward to this year, now it's still measuring point to point, but it's going to be much more negative, right? Now we only have 1% annual growth from here to here. Now in this case, assuming earnings don't continue to fall or don't ever grow again, this would be really negative, right? So, and the market can react to that kind of short-term negativity sometimes and send stock prices down a lot. Now, I have been negative on Nike, and you can watch those videos if you want to see what I thought at the time and the reasonings why. But we want to make sure that we're not exaggerating things too much. We don't want to be too optimistic, and we don't want to be too pessimistic. Usually when other people are pessimistic and you're can see that they're overly pessimistic, that's when you can make money in the stock market, right? So the other thing I want to point out for Nike, and I probably pointed this out in my other videos, is they did buy back a lot of shares. So I did this on going back 10 years, a lot. I mean, this is somewhat typical for a mature S&P 500 company. So they bought back about 14% of the company. So because Fast Graphs uses earnings per share, when they reduced the number of shares each year by a little bit, that wasn't each year, that was over this whole period. So, 0.5% a year or something like that. But that adds up over time. So as the share number gets reduced, the EPS number, earnings per share, goes up, even though they aren't necessarily making any more money. They just reduce the amount of shares that are available in the market. They bought their own company back, basically, share buybacks. I like to include those in my earnings growth rate too, or deduct from those. They aren't good or bad necessarily on their own, but what I want to know is if I owned this business, how much money would I collect before I bought back stock, right? Before I paid a dividend. People ask about dividends too. It's the same way. Buybacks you can borrow to do all this stuff too, but in the most basic terms, the company earns the money, they have earnings, and then out of those earnings, they can pay a dividend, or they can buy back shares, or they can reinvest in the business, or they can reduce debt. And those are the main things. There's a few more if you're dealing with complicated things, but in just kind of getting a big picture of how things go. And if you look at most S&P 500 companies, they have kind of these standard sort of things that they're doing, like buying back a little bit of shares, paying. I want to say Nike was always a pretty good example, because about 1/3 of their earnings they paid out in a dividend, about 1/3 they bought back shares with, and about 1/3 they kept. Now, the stock price, let's see where we're at now. Hold on, let me move it forward one more year. So they had a smooth, roughly, you never know exactly what price they're paying for their stock, so this is always just an estimate. But basically, we're at $68 a share, and they were buying back shares all the time since 2018. They've been overpaying for the shares because the stock price is lower now. So all those little investments that they made in Nike we can now say were poor investments. Unless maybe they were bought a bunch right here. But usually these tend to be automated with these big companies. They don't try to use any kind of judgment. Part of that probably has to do with lawsuits and things like that. But they don't have to. Berkshire doesn't. There's a couple other companies. Teledyne, I think, doesn't have steady amounts that they buy back. So if you buy back your stock when it's cheap, that's a really good deal, especially if you buy back a lot of it. If you buy back your stock when it's expensive, then that's not a good deal. And most of these companies don't really use a whole lot of judgment when it comes to that, honestly. And And it's not my preference, but since there's only like half a dozen companies that use any real judgment when buying back their stock, I just have to deal with it. But it's worth kind of pointing out that, that wasn't a good idea ultimately. Okay, so, but I account for those. So my earnings growth rate, again, is going to be lower than that 8% that we looked, 8 to 9% we looked at earlier. But it's also going to be based on, I don't remember the last time when I updated it, I don't know how far these earnings expectations had fallen. But we'll assume I was probably basing it, I'll look at them out here in just a second, but it was probably based on this kind of run from 2016 to 2024. I can kind of tell that, or 2015 maybe even. Now 2015 was 25% growth, so I wouldn't have counted that because I know that they're not growing anywhere close to that right now. So here's probably what I was looking at when I established my earnings growth rate. It's almost 9% for the earnings per share. Let's get into that. So we need two things to do this this is going to be a slightly different analysis than my other ones. I'm really focusing on this time until payback analysis for my videos now because it's pretty straightforward and simple to understand, whereas my other strategies can be a lot more complicated for somebody who's new that's coming in, maybe that doesn't have like a lot of experience, doing investments. And then I have a lot of little things that I do differently than everybody, so that complicates everything. So the simple way to think about this is if you bought Nike's whole business as a business owner for like $100, how long would it take that business to earn $100 in earnings? Okay. And again, those earnings come before the buybacks, before the dividends and whatever else they want to do. So I want to know if I own the whole thing. And one way to think about it is if they paid all their earnings out in dividends to me as the owner, how long would it take me to earn the amount that I paid for the business back? And I use $100 as the simple way to do that. So obviously you could scale up to $1 trillion if you wanted to, but the math is basically, the time is all the same. So you can see here that using my assumptions right now, it would take 13 years. But there's more to that, so hold on just a second here. So this 5.18%, let me move my head down a little bit. Most of these titles are going to be meaningless to people. This is just a little worksheet that I built for myself. I don't even share this one in the Cyclical Investors Club, so there can be other stuff up here that doesn't really apply here. So just ignore the things. But this is the earnings growth rate, okay? 5.18%. So you saw fast graphs, if you use last year's earnings, had 8.7-ish% earnings growth, and if you use this year's earnings, 1.0 interest or earnings growth rate, and you can see mine is kind of in between, and I haven't really updated it too much. I think the last time I updated it was in January, but I don't know if I redid the whole earnings growth rate, right? So you can see I'm kind of in between there, which I think is a reasonable earnings growth rate, especially because what I'm going to do here is a little bit different. So the earnings per share that I'm going to use is $3.95. So let's go back to, this is actually what they earned last year. All right. So there's going to be some assumptions in here. Let's widen this out a little bit now. This year, they're only expected to earn $2. So it's like half basically of what I'm using in the spreadsheet right now. I'm using these peak earnings. So what's going to be embedded into this valuation that I use is that they can recover back to these 2024 earnings. So I'm assuming that baked into this decline, they're going to recover. And we'll talk about that in a minute. Because what can happen is, let's say next year they recover to $3.95. Well, the stock price will rise a lot if you're waiting for that before you buy it, right? So you have to kind of make some assumptions ahead of time if you want to potentially buy it at the cheap price, or the low price, I should say, that it's trading at right now. We'll find out if it's cheap here in a second, okay? So very generous earnings growth starting point. This is important because the earnings yield is going to be based on this number right here, right? If I change this to 203 or whatever it was, you can watch the earnings yield. It goes down to 2.88 instead of 5.06, right? 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 2.88 instead of 5.06, right And this will be the base that we start from to accumulate our projected forward earnings. So if you pay $100 for the business and the earnings yield 5.6%, that means you would earn $5.60 the first year with no earnings growth. And if it was like what I say, 2.88%, you'd only earn you'd earn almost half, like $2.88, right? Your first year. I'm going to assume that this now, if a business bought, let's go look at this is becoming way more complicated than I thought, but I think it's actually going to be good. So if we go back here, we can see that if they had a similar decline, for COVID. All right, so they had a 36% decline in earnings for the COVID year, and you can see that the next year earnings grew 123%. So this is where things get really wacky if you're only looking at the short term, right? So if I was looking in 2019 and I used $2.49 instead of 160 and then projected a nice smooth historical 8% or whatever you wanted to do for earnings, there might have been a point here where the stock got cheap enough, even though it was a PE of 38 during March 2020, where it might have gotten cheap enough to buy if you kind of kept your head and assumed that they would recover, right? If you can see kind of what the market did actually, and this happens a lot, and this is how you can make money in the stock market. It initially overreacted to this earnings decline of 30%. The stock fell 35%, so almost right in line, maybe a little bit more than that. And then when earnings, that's over like 1 year, that's just 1 year's of the time, which is usually what the market looks at. And then earnings grew 123% the next year, and the stock price grew, I'll just pick this first peak, move my head out of the way. Stock price grew 156%, okay? So you can see how near term the stock market's looking compared to what I'm doing, right? I'm trying to smooth things out, really it's more of a medium term view, but it's looking at the long-term possibilities to kind of project 2, 3, 5 years in the future or so with the stock price. So when I did my analysis in 2021, what was it? What did I say? Are we in 20? Yeah. And we'll just do right here. When I did that analysis, it traded at a 50 PE. I don't know what the earnings growth rate was, but it wasn't that fast. I mean, it was growing, but not that fast. And so it was really expensive. And when I couldn't project the next year. The stock price still rose the next year a lot. But looking out, I could tell that eventually it didn't look like earnings were going to support a 50 PE ratio. And so now we have a 50% decline from that. That was based on valuation, but let's see what happened the first year actually. Move this out of the way. So it went up 20% after that. So I made that sell video and the stock price rose over 20%. With dividends, it was over 25 in 1 year. So you say, oh, well, you were wrong. Well, not really, because eventually the earnings are way on the stock price. Now, especially up until this big decline, like earnings just flattened. They didn't really go anywhere and the stock price still fell a lot, right? Now we have a real earnings decline and the market's it's a little bit different because something has really changed. I didn't forecast a big earnings decline. I was just saying if earnings kind of do what they've always done, the stock was way too expensive, right? So when was the next time I looked at it? October 17th. June. Oh, that's this year. Yeah, so almost at the bottom probably. Yeah, started to come back. All right, so right in here, when it was about $100 a share. And again, it probably went up. Yeah, so you get this big spike. It went up immediately, another 20% rise, but then kind of reality set in and they had disappointing earnings and it came down, okay? But the market is looking at this short-term blip, projecting it out, sending the stock price down, looking at this 100% rise, and an investor, if they can look ahead of that and see it and see what could happen in the future that's not happening right at this very moment or in the next 12 months, then that's how you can make long-term money, right? So you can imagine that if the stock is trading here at $68 a share and then maybe not this year, but next year they go back to $3.95 a share, then the stock price is probably going to do pretty well, right? So I'm trying to be kind of optimistic, or it is optimistic, honestly, to get a valuation based on that. Partially because I know this is kind of bearish compared to most valuations. And so I want to use a bullish starting point, right? I want to be optimistic at first and see, look, even if things go well, like what are we looking at here, right? So if they get that immediate bump, just like they did after COVID, and earnings rise 100%, and not this year, but next year, that gets us to 395. And then I say, okay, what if they grow their historical rate after that at 5%, which is 5 to 6%? That's what I'm calculating right here. What does it look like then? So it's being optimistic and then realistic is how I would describe it, right? So when you do that, it takes 13 years for you to earn your initial money back. So if you paid $100, it would take, using these assumptions, it would take 13 years to earn $100 in earnings from the business. I like this to be, for a growth business, like 12 years is kind of the maximum. And then for a not real fast growth business, like a mature business, more like 10 years is what you want. Lower is better. You want to earn your money back faster so you can reinvest it and compound and make more money over time, right? So using these assumptions, we get a 13-year time until payback. Right now, the S&P 500 average is about 15 years. So using these assumptions, it looks better than the S&P 500, but not a 10-year time until payback, which would be potentially better than average, like really good returns with a margin of safety and all that stuff. So at $52 is where it would hit the 10-year return assumption mark using these assumptions. But, and I would say, all other things being equal, if a person wanted to start a small position there, that's very reasonable if they like the business and they think it can recover. But the caveat to that is that assumes, I would say, a 1 to 2 year return to this $3.95 earning level, right? So that would, if you just look at it right now, and like, I would probably say 2 years is what would be reasonable for that, just as a basic assumption. So if you add 2 years to the 13 years, you get to 15. That's right where the S&P 500 is. So if you think it would take 2 years for a earnings recovery and then they grow at 5% after 5 to 6% after that, it's valued just the same as the S&P 500 and pretty expensive, right? So I wouldn't be buying until it was at least below $52. Now, I'm not predicting where it will go, right? What I'm saying is, I don't know exactly what the stock price will do. What I'm saying is, if it gets below that level and you think the earnings will recover and you bought some there, you have a high probability of getting good medium-term returns over the next 3 to 5 years in the stock. Right now, I think it's priced about the same as the S&P 500. If you assume a recovery like that will take a couple years. And so that is where I think that covers just about everything and maybe a little bit more. I have owned, I don't know if I made a video on Adidas. I owned them. I just trimmed and we got almost a double. I think it was about a 90% return. And it was a turnaround. It wasn't like a turnaround. You guys always hear me say that I don't really buy turnarounds, but it had kind of a one-time hit combined with a recession-like environment to set the stock price down over 65%. And so in some ways it was a little similar, except for I could identify, the Yeezy shoes thing was probably a one-time thing. I could identify they still had a strong brand. I could identify that there was macro issues that weren't specific to them that were sending the stock price down. I don't know that I can say all that about Nike here, but I'm not against buying things when they're cheap and kind of waiting a couple years. So I bought Adidas over 2 years ago, I think it was. Yeah, it was 2022. So like 2.5 years ago. So that's kind of what it looks like when it works out. If you bought Nike and it took a couple years and earnings did recover here, the stock price would start anticipating even better returns and it would go much higher than the slow returns, that earnings returns that I'm talking about here. So, and those are the returns I like. Like if I can get a double in 5 years, That's usually kind of, or some part of that, you know. That's kind of the rough threshold that I like to use when I'm buying something, when the thesis works out. So that's I guess how I think about Nike. I would say it's a hold here probably, because it's valued about the same as the S&P 500. If I had to, or I wouldn't say a hold necessarily, but I'm just neutral on it. Like, I don't have a strong opinion. It's not cheap enough for me to have a buy opinion. It's not expensive like it was during the last two articles or videos. I've written on it too. So how far is it down from here? Just see. Yeah, so it's down 35% from my last sell video a year and a half ago. So this is one I mostly got right, and hopefully you guys find that useful. I have a weekly picks over on Patreon for $25 a month. Every week I find the best stock I can find in the whole market, and that's the one that I share. Even if it's not perfectly exactly where I wanted it. You know, if I looked one week and Nike was at 57, it was the best thing, and it wasn't at 52 where I preferred it, then that might be a pick, right? That's kind of how it works. Forces me to pick things. It's doing really well. I started that in October, and I think we're like doing at least 3 times better than the S&P 500 picks at the same time, like if it was picked at the same time. So those Patreon links will be down in the description. I have a free tier on Patreon too, where I post all these same videos that I post on YouTube. And I'll see everybody later.